Hello and welcome everyone to AUT Financial Modeling, your go to destination for mastering the art of financial modeling. Today, I'll walk you through the advanced three statement financial model. This model has five main parts. First one is the summary, which includes tabs like executive summary of your model, your dashboard, the financial ratios of the company, and a break even analysis. Next up, we have the input tabs, which includes P&L, balance sheet, and revenue drivers. Third is your output tab, which has the output of P&L, balance sheet, cash flows, your beta and WACC calculation for public companies, and your DCF valuation to value your company's share price. Next up, we have revenues. We have revenue charts of EBITDA, cash flows, and a chart representing the EBITDA bridge. And the last, we have the source of the data, wherein we source P&L and balance sheet data. So these are the main sections of this model. Now I'll walk you through each and every section individually. Let's look at the summary sheets. First one is the executive summary sheet. This sheet contains the key financials that are there for the company. These includes revenue, gross profit margin, your EBITDA, net income, net profit margin, and the other main parameters for the cash flow, such as net cash flow, free cash flow, enterprise value to your revenue, and your enterprise value to EBITDA ratios. Next, there are return on equity and the return on capital employed. Then also we have charts representing revenue versus EV by revenue. Then we have EBITDA by EV by EBITDA. Then we have cumulative cash that has been accumulating over the years. So this was the executive summary sheet. Next is the dashboard, in which there are many key parameters that anyone would want to have a look at for analyzing a company. So this includes revenue versus gross margin chart, revenue versus operating margin chart, and your income statement chart. Next, it also has charts in working capital, the cash flow, and net income versus net cash flow. So these are the all important charts that anyone would like to have a look at if they're trying to value a company. Next up, we have the financial ratios. So the financial ratios are divided into four major categories. First one is the profitability ratios, which includes return on equity, asset, and capital employed. And then we have a gross profit margin, operating profit margin, and net profit margin. Next up, we have liquidity ratios, which include the current ratio, quick ratio, and operating cash flow ratio. Next, we have efficiency ratios, which includes the receivable days, payable days, and inventory days, and the cash conversion cycle. At last, we have the leverage ratios, which represent debt to equity ratio, shareholders equity ratio, and debt to total asset ratio. Equity, we also have a chart representing the all three major liquidity ratios. That is the quick ratio, current ratio, and operating cash flow ratio. We have two other charts representing the efficiency ratios, that is the accounts payable, accounts receivable, inventory days, and the cash conversion cycle. We have leverage ratio charts showing the shareholders equity ratio and debt to total asset ratios. So in all, this gives a good overall look into the company's financials. At last, we have the break-even analysis of the company, which is the level at which the company is not making any profits. So for that, we have the total sales and margin. So your general total sales, gross profit, and gross margin. Then we have our variable cost. Then we have our fixed cost. Then here it is the yearly break-even amount in sales that a company needs to make so that it is not making any profit, and it is also represented in the manner of monthly sales that it needs to have. Herein we have the sales volume, the fixed cost, the the variable cost per unit, the sale price per unit, and the per contribution engine overall, and then break even point in terms of sales volume and break even point in terms of dollar value or pound value. So here you have your summary sheet in which we have discussed all 5 sheets that are present in this model. Next up, we have the input tabs, which include our P&L assumptions. Here we have the assumptions. First of all, the main assumption is the scenario we are planning or we think that will be applicable to a company. There are 3 cases. One is the optimistic case, second is the base case, and third is the worst case. So we are making assumptions based on these 3 cases. In the input tab, or in the P&L tab, we have our revenue projections or the estimate. So the area in gray shows the forecast for the es- estimated period, that is afterwards we have the historical data. So such as in this case we have the historical data till FY22, and from FY23 to FY27 we are forecasting our data. So the area which you see in gray tab will be the assumptions that we are making about the growth of revenues. Similarly, we are making assumptions about the growth of the COGS as a percentage of revenue. Next, we have expenses as a percentage of revenue. Similarly, we have depreciation and amortization, and then we have the interest expenses. At last, we are assuming the tax rate that will be applicable for our company. Next tab, we have the balance sheet assumption. In this, we are projecting 5-6 parameters that will go into the balance sheet. First is the trade receivables and the days receivables. Then we have inventory and days inventory. Then you have trade payable and the days payable. Then we have property plant equipment as a percentage of revenue. Next we have other assets as a percentage of revenue and other liabilities as a percentage of revenue. In the last sheet of input we have the drivers for the revenue. So we are assuming in this case that our company's revenue is equal to the number of units sold multiplied by the average selling price of a unit. So on that basis, we are projecting what will be the year-on-year growth in the average selling price and what will be the year-on-year growth in the number of units that are being sold. Based on that, we are calculating our revenue, what will be the revenue in the future. So next up we have the raw materials and what would be the fuel cost. So measuring all the variable costs, and then we are measuring what will be the contribution per unit. That is the top line revenue minus our gross cost or our variable cost. So next up we have the employee cost year on year growth we are measuring in this cost. Then we have SN, selling and administrative expenses, we are measuring its growth year on year. Then we have other operating expenses, that is measuring the fixed cost. With this, we are at the end of input sheets, and now we are look at the final sheets or the output sheets for our model. At first, we have the P&L. We have pretty basic P&L that shows the revenues, cost of goods sold. Then we have gross profits, that is the revenues minus the cost of goods sold. So the cost of goods sold is present in a negative term here, so that's why we have just added it. Similarly, all the expenses are present in the negative form. So from gross profits we deduct the operating expenses, then we get our EBITDA. Then after subtracting depreciation and amortization we get our EBIT levels. Then we have the interest expenses, and next then we get our interest before tax. So this is the tax rate that we assumed in our P&L assumptions. So This will be applicable here, and based on that, tax is calculated. And after deducting the taxes, we get our net income. Next, we have the balance sheet. So in balance sheet, here is our asset side. So in assets, we have the intangible assets, our property, plant, equipment, long-term investments, and other fixed assets. So these are our fixed assets, or you can say our long-term assets, and these are short-term assets or non-fixed assets. These include deferred tax assets, inventory or trade receivable, and other assets. So the items that you're seeing in yellow are those that we have projected, and for the rest of the items, we have taken the assumption that these will be flat. So for example, in case of intangible assets, we are assuming that our intangible assets will remain flat in the forecast period. So you'll see that in the whole forecast period, the value of intangible assets is same as the last year of actual data. Similar is the case for long-term assets and other fixed assets. You can make the changes in whatever way you want, because this whole model is customizable. Next, we have the inventory, trade receivable, and other assets, which were all the things that we projected in our balance sheet assumption sheet. Then we have our cash calculation. So this will be done with the help of cash flow statements. So we'll get to that later. Here is our liability side. These are our liabilities that are short-term liabilities, and these are our fixed liabilities. Then we have our shareholders equity. Here we have done a sanity check in which we have looked at if our liability side is matching the asset side. Next, we have the cash flow. We have a very traditional cash flow. Herein we have EBIT, then we deducted the taxes and non-operating taxes, so we get a NOPAT. Then we add back the depreciation in this, we get a gross cash flows. Then we do the treatment of assets and inventories. An increase in the asset will result in decrease in the cash flow. That's why there is a negative there. And an increase in the liabilities will result in increase in the cash flows. That's why we have done this. Next, we have our investment in working capital and the change in asset liabilities. Then we have our capex, then other investments. As a result, we get our unlevered free cash flow, which shows that uh, it is comparable for any two companies, because it is not taking into factor the leverage or the debt, the total debt the company has taken. So this unlevered free cash flow metric is very important when you're trying to compare two companies that have a very different capital structure, the debt and equity structure. Next up, we have our financing activities, which show the interest expenses, change in operating tax, liabilities, and dividends and all. Then we get the net cash flow for the year. Then here we have the opening cash flow, which is equal to the previous year's cash flow. And here we have closing cash flow, which is equal to the opening cash plus our net cash flow for this year. Then here we have uh, done the simulation for the forecast period. So in the gray area, you can see the forecast is done for the period that is after the historical period gets over. Here we have done a sanity check, wherein we check if the closing cash is equal to the previous the figure that is present in the balance sheet for the cash. Next up, we have the beta calculation. So for beta calculation is done for the companies that are listed on exchanges and are publicly traded. So herein we have the stock market index pricing. This is the monthly change in the price. Here we have the stock closing price, and here we have the percentage change. So we can calculate beta by two functions. One is a slope function, in which we take percentage change in the stock as first argument and the percentage change in the index as the second argument. Next, we have the covariance method, Herein we divide the covariance of the percentage change in the stock and the index with the percentage change or the variance change in the exchange. So you can see with both the methods we are getting the same beta. Next up we have weighted average cost of capital calculations. Here we have used the method of capital asset pricing model to calculate the cost of equity. You can see we have the C6 as the equity risk-free rate plus the risk premium of the company and the beta for the company. So by this we get the equity cost of equity for the company. Next we have cost of debt, which is just equal to the interest rate paid by the company multiplied by 1 minus tax rate. So herein we have debt. Here are the proportions of equity and debt, and for fact calculation which is multiplied the cost of equity and debt by their respective weights. So that's how we get the cost of capital, that is weighted average cost of capital. In this sheet we are doing the valuation of the company. So these are the unlevered free cash flows that I was talking about a moment ago. These are the discount factor, which is calculated based on two variables. First is the weighted average cost of capital, which is equal to 11.1, we just calculated. And second is perpetuity growth, which is the rate at which we assume our company will keep on growing after the forecast period is over. So for discount factor, we'll just take account into the WACC, and for the calculating the value of the company after the forecast period is over, we'll take into account the perpetuity growth. So these are the discount factors. We multiply the discount factor with the unlevered free cash flow of the respective year to get the present value of cash flow. Now we have the present value cash flow and the continuing value. For continuing value, what we do is we calculate it via the last year's cash flow multiplied by the growth rate. So we are in the year 27. Here we'll look at this. So L7 is the last year's cash flow multiplied by 1 plus perpetuity divided by WACC minus perpetuity growth. So that's how we calculate the continuing value of the company. This multiplied by the factor of discount we have in the last year will get us the present value of continuing value. That's how we get the enterprise value. Herein we have liabilities for the company in the last year and the cash that is available. So for equity, we just did finding the equity value. We deduct the uh, liabilities that we have from the sum of enterprise value and cash that we have got on a balance sheet. This gets us the equity value. Here we have the total number of shares that are present, and we divide the equity value by the number of shares, and that's how we get the value per share of the company. Here we have done a sensitivity analysis for a company, that is what will be the enterprise value of a company if the WACC and perpetuity growth rate changes. So herein we can see the sensitivity analysis. Next up we have the charts that we prepared for a company. First is the revenue and EBITDA chart. You can look at it. Here are the historical figures. This is the forecast period. Next we have cash flows. It represents two values. First is the unlevered free cash flows, and then second is the present value of those cash flows. Then we have EBITDA bridge, EBITDA in the previous year, what were the changes in revenues, changes in COGS and OPEX, and the EBITDA in the next year. So after this, the last section is the source sheet, in which we take the P&L data for the previous 5 years, and we take the balance sheet data for the previous 5 years. So these uh, information can be sourced from the company filings if your company is public, or you can source the data from any other filings that the company has done. These type of information is readily available for the publicly listed companies. With this, we have come to an end of this video. Hopefully you enjoyed the video and learned something new today. So if you want to access this model, there will be a link in the description, or if you have any queries for us, you can email us for any queries. Thank you everyone for watching this. We are signing off for today, and we'll be back with another video in some time. Thank you.